Hey guys, I'm still traveling, so you probably won't see me behind the screen for a little while. But, one thing you guys made very apparent is that you guys want to understand what the options chain looks like for Alibaba. And once again, I was originally going to charge for this model that I built for you guys, but then you know what I decided? This is not worth charging for. You guys are better off just learning this stuff because really what options can do for value investors is really help us reduce our risk. And there's been a lot of times this year where my butt's been saved because I entered into options positions as opposed to just flat out buying the equity. And so that's why I like to cover this for you guys. And so you guys want to see the covered call options opportunities, and you also want to see the cash secured put options opportunities. And so I'll speak about those with you. But just for anybody that's new to the channel, just an FYI, I am a value investor. The only way that I guess I would just call myself an investor. I don't think there is such thing as a value investor. I think all investors are by and large value investors because ultimately you're looking to pay less for something that's worth more. But when it comes to options investments, what I try to do is I try to reduce the risk as much as possible. You can put on risk with options. That's just not what I do. And so when looking at the covered call opportunities, the thing that I would look at with Alibaba is it's currently trading at $77 per share. You can look at the $75 per share covered call, which would be an in-the-money covered call, or you can look at the 80. I will leave the 80 one for you guys to do, but I'll do the $75 one with you. And so in the description of this video is a model where you can just go in, hit file, save, and then you just have this Google Sheets forever, and you can manipulate it, put any securities you want. All you have to do is put in the ticker, and the Google Sheet pulls in all the information for you. So it's actually pretty wonderful. But what we'll do is we'll work with this $75 covered call. And so this is what the sheet looks like. So only in the blue do you enter information. And so, I would enter in the BABA ticker, the exchange, and then it will automatically pull in the ticker code and the price. And the close price on Friday was $77.60. Then I would enter in the exercise date, the price, the premium, and the expected dividends. Recall, guys, that investors now expect $1 per share every year from Alibaba. Correct me if I got that wrong, guys, but I believe it's $1 per share for every share traded on the New York Stock Exchange. And so the annualized yield is essentially just you got your premiums. You technically over the life of this option, it's 426 days. Technically, you expect $1.17 in dividends. I don't know if they're going to pay it annually, but of course, if they pay it annually, you just have to override this and just put $1 because if you were to buy the shares today, you'd own it for 426 days. But if they only pay the dividends once, then you only get $1. But keep in mind that you are buying shares at $77.60. And you're entering into a covered call where you're willing to sell the security if it trades above $75 per share, which means 77 less than 75 is the 260 of a loss that you're taking. And so your total cash inflow is actually $14 per share. Now, if you were to just take that $14 per share and just divide that by the 77.60, you get 23.1%. But that is assuming that that's over 365 days. It is not over 365 days. It's over 426 days. So we have to annualize it. And so what happens is your total annualized yield, if you are assigned on the covered call and lose the shares, is this section right here, and your total annualized yield is 20%. That is not bad. It's above my threshold of 15%. In fact, the options chains have been very lucrative lately. That my threshold, I just reset it to 17.5. I've just been surprised with how lucrative the options chains have been in 2023, and it's part of the reason why the portfolio has done 40% this year. But once again, I don't expect that to repeat going forward. I'm not that smart. And so when we go into the what happens if you are not assigned on the covered call, effectively what happens is that you own the share at a reduced cost basis. And so, you bought the shares, you own them, And so you just continue to own them, but your cost basis has been significantly reduced to $60.68. And so that's really just that 1432 less the 7760 minus the 1432. And so, compare that to the valuation, it's only 30% of the intrinsic value. Now, nobody is saying that Alibaba is not cheap. But the one thing we are saying is that in order for this valuation to be achieved, you need China commerce to continue to grow. And last quarter, we saw China commerce start to slow down. So I'm a little bit worried about that. Do I have to revise this valuation? I really want to think about it, but I think I might revise the valuation down slightly. But I want to mull over it a little bit more. And so the full year EPS run rate is $5.39. So, if you're buying the shares at $60 per share, $5.39 gives you an 8.9% equity yield. But hold on. From this cost basis, the 60.68, I would say at least $25 per share is cash. So if you were to just take the 60.68, which I'm doing right now, subtract out that $25, you have $35.50, call it. So you take your I'm doing it with you guys, 5.39 divided by 35. Your true equity yield is something around 15%. And so what does that mean? That means we've met my threshold on both, because I do not enter into options opportunities unless I have a 15% equity yield here and a 15% annualized run rate here, which right now is closer to 17.5 minimum. And then the equity yield has to be 15%. Now, previously, I did enter into an options opportunity with Alibaba where my cost basis was 70. So it's like I do bend it sometimes, especially for companies like Alibaba, where this is actually expected to continue to increase. So it might not be 15% in the year in which you get exercised or not get exercised, so you're still holding the shares, but you expect it to within the next 2 or 3 years to pass that 15% range. And so if this doesn't make sense to you guys, let me know in the comments below, and I can do a couple more examples for you. But this is not really an 8.9%. I think once you deduct the cash from the cost basis or that excess capital, you're in that 15% range. So that's what the covered calls look like. They look very exciting. And, I think this is something that, I don't give you guys recommendations on what to do and what not to do. But this is something that I'm considering strongly, considering that my Alibaba options positions came off earlier this year. Now, with the cash secured puts, here, the $75 cash secured put, you can probably sell this for about $9.50. So that's the way that I'll forecast it. And so you can see here, that's exactly what I'm doing. The money market rate is 5%. Really what's happening here is when you enter into the cash secured put, the whole point of it being cash secured is you have the cash available, you set the cash aside. It will generate at least 5%. I wouldn't recommend that you do anything fancy. So I would say just allow it to just generate the money market yield. So that's 5%. That enters into your return for this particular opportunity. And then, of course, you enter in your date, the exercise price, and the premium. And so overall, what ends up happening is the premium that you generate is $9.50 plus the cash interest earned on the cash set aside is $3.82. So you earn a total amount of cash of $13.32 for a net amount of cash set aside, which is $65.50, because you don't have to put aside the whole $75. So that's how this works. On a simple basis, you've made 20.34%, but of course, because it's annualized, it's a 17.43%. Of course, so that's what happens if you are not assigned on the cash secured put. So if the shares are trading above $75 by January 17, 2025, you are not assigned on this. You just get to keep the $9.50 plus the $3.82 or the $13.32, and now your cash is available to invest in something else. Now, what happens if you are assigned on the CSP? Well, if you're assigned on the CSP, well, remember, you're assigned on it at $75 per share. However, you brought down your cost basis, and so your net purchase price is $62 per share. Compare that against the valuation. You can see, of course, nobody's arguing that Alibaba is cheap. Maybe this comes down to like 180 or something, the valuation, but it still would be very cheap. And then the run rate is very good. But once again, you have to subtract the excess capital from the share price. And so you probably have an EPS run rate, an annual equity yield of somewhere around 15%. So that's the way I'm thinking about this. Now, I was just guessing what the excess capital was. And so what I did was at the end of this video, I actually built it out. So they have some cash, they have some short-term investments, they have some equity securities, they're short and long-term, and then they have some debt. Now, if you want to be super conservative, if you want to be a little bit conservative, take out the investment in equity method investees. That's not super liquid at all. So I would take that out. But if you want to be even more, I would say conservative, take out the long-term equity securities from this number, which is the majority of this number. And you will probably get to an excess capital per share of around $20 per share. So that's probably how you want to think about this. Or if you're doing it the way that I'm doing this, $35 per share is the excess capital. So if $35 per share is the excess capital and the net share purchase price is $60 that you're generating, well, then you take that 5.5 divided by the 25. Yeah, you're looking at an equity yield of 22%. So this gets pretty interesting depending on how you want to look at the excess capital. Now, the only thing about the excess capital is they haven't been deploying it. So do you even want to consider the excess capital into your calculation, or do you want to consider it sunken capital? I don't know what the answer is, and that's what I want you guys to answer in the comments of this video. Let me know how much of their excess capital is just sunken capital that they're not going to allocate out through share buybacks or dividends or anything along those lines. Let me know in the comments below. I respond to everyone, so I'll leave it there, and I'll talk to you guys later.